Time as any to get our special guests into our discussion. Ridham Desai of Morgan Stanley joins us now to talk about the markets and, of course, to tell us what he's planning to do from this Diwali to next in terms of investing. Ridham, hi, good afternoon. Happy Diwali to you. From last Diwali to now, the Nifty has not done anything for investors. What's your sense? Will we make decent headway from this Diwali to next?
So firstly, a very big happy Diwali to all the viewers and a very prosperous new year. I hope everybody makes more money than they made last year. Well, you know, when I look back on the Samvat last year and, you know, we were optimistic on the markets. We were hoping that the markets will give returns, and frankly, they have disappointed us. It's not been one of the brighter calls. I think earnings have lagged our expectations. I had a much bigger call on earnings. And if I look at why that has happened, it's happened because export growth has been weak, and that's because global growth has been weak. So I think that's the prime reason. The other reason is that PPI has been in deflation, and that's hurting corporate revenues. So even if you look at this quarter, for example, even though margins are up 500 basis points on the aggregate, which is a massive increase year on year, we still have very feeble earnings growth because revenue growth is actually down for most companies. So I think those are the two things that India needs to overcome. You know, in fact, oddly enough, India needs a bit of stability in commodity prices. It's helped our macro, but it's hurt our earnings, and I don't think it will do good to India if commodity prices fall much more from here. And it requires a little bit of stability in global growth. And if those two things come along, then I think the earnings picture will improve. So I'm actually retaining my optimism and hoping that what we didn't make in the last Samvat, we'll make in the next Samvat. So I think equities look actually quite reasonably poised. Valuations are looking a bit more attractive than they were last year. On a relative basis, India continues to have a very strong macro. In fact, you know, you make the point about India not having done well, but on a 6-month trailing basis, for example, India is still the best performing emerging market in the world. So it's more to do with what's happening in the emerging world. And the best performing emerging market in the world is actually down 5%. So, you know, that's the problem that India has, which is that equity returns have been anemic across the world. And a little bit of boost from that will do good to Indian equity returns on an absolute basis.
Okay, by the way, the market is now at the low point of the day. It's broken the morning low, and that's where, you know, you saw the additional fall. In fact, the Nifty is now in danger of breaking 7,800. 7,802 is what we have right now. Ridham, hi, good afternoon. It's not been a good Samvat, at least the last few days. There are some headwinds for the market. The Fed may hike rates. Also, the government, after losing 2 states, may not be able to make legislative changes. Will stocks be able to make decent returns despite these issues?
Of course, those risks are there. There are a lot of risks on the horizon. I think the Fed thing is, I worry a little less about that. I would rather have the Fed lift off. For one, it takes the event behind us, like the Bihar elections, and you can see how the market is responding. You know, the event is behind you. The second is actually it's a signal that US growth is okay. And if the Fed is not making a mistake, so it's reading this right, that won't be bad for India. It is very different from the summer of 2013, when India was running a very challenging macro situation with a high current account deficit, high fiscal deficit, and high inflation. And a potential lift-off then proved to be quite fatal to both the equity and the currency markets. This time around, actually, India is, you know, as it has been for the past several months, the best house in a bad neighborhood. So I think India will actually react well to a Fed lift-off. With regards to the policy making of the government, well, for sure, you know, the Bihar election can be viewed as a setback, but I can also view it the other way. I can view it that, you know, it will actually egg the government to, you know, push forward things that they may have been hesitating on because they may see the urgency to revive growth in a stronger way than what has happened so far. I mean, nothing taking away from what has happened in the last 18 months. But I think a lot of market participants may have hoped that things would have happened faster, and maybe this is the trigger point. Legislation, I think that challenge doesn't go away. Even if the NDA had won the Bihar election, that challenge is there with them till the end of their term. The Rajya Sabha majority position or the minority position of the NDA doesn't change in the next 3 years. They need to work with the opposition to get that legislation done. The good thing from a stock market perspective is I think the expectations are pretty low now compared to where they were 6 months ago. So if the GST bill does get passed in the winter session, I think it will be a mild positive surprise rather than the other way around. And hopefully it is done. And that will be good for the markets if it's done. So I think maybe the Bihar elections make the government a bit more proactive in getting these things sorted out rather than the other way around.
Okay, those are all the macro issues, Ridham, but let's start talking about stocks now. If you take stock of the year gone by, the biggest gainers have been the pharma space, so stocks like Lupin, and the technology space, so stocks like Infosys. In your assessment, what will be the leaders of this rally in the next 12 months?
I think we are probably going to see a little bit of a shift there. There are a few consensus trades out there, which I don't think we are abandoning. But for example, we are now clearly underweight healthcare. So we don't think healthcare is going to be at the top of the pack as it has been for the past 5 years. In contrast, we closed out our underweight position in utilities last week. And luckily for me, the government announced their big SEB package. It's still early days. The market doesn't buy into that story. But I think, utilities have been hammered and they seem to be priced for nothing now. So I think there are a few changes that may happen. Private banks, I think, may continue to do well over SOE banks. That may be one of the continuing trades of the last 12 months or 24 months. I see some positive signals for discretionary consumption, whether it's in the auto space or it's in the broader auto space, not just the car manufacturers, but broader auto space or media, or for that matter, other areas of discretionary consumption. I think there's a clear sign that job growth is back. And I think it's being led by the internet sector, which is not something we are measuring so accurately. And therefore, I think that may be an area of positive surprise. I'm actually constructive on technology. I think a Fed lift-off is good for tech sector. And the tech sector should do well into a rising or a positive interest rate environment in America. So there could be a few changes from, say, the last year or 2 years or 3 years. With some of these so-called low beta defensive sectors giving up their gains in favor of, say, infrastructure. I'm quite positive on the railways. I'm very positive on the infrastructure space, and maybe power utilities to some extent, and discretionary consumption.
Okay, I guess one of the triggers for growth could also be more rate cuts, Ridham. We've seen already some of that, but the governor has maintained that he's open for more. By next Samvat, how many rate cuts do you see?
Okay, our official forecast is ending from the year ended March, and we expect 1 to 2 more rate cuts. Our economist has been pretty spot on. He started the year with 125 basis points as his base case, and we've got there. So I think I'd go by his view that we have another 25 to 50 basis points in the next 6 months, which is very, I think I need to actually spend a couple of minutes here on this. It has never happened in India's history since we opened our doors to foreign investors that we have cut interest rates in front of a Fed hike. So this is the first time it is happening, and it underpins the point of India's macro. That is, our macro is in such good shape from an external perspective that we have the courage and the capacity to do that. And that's, I think, a very positive signal for equities. So I think rate cuts are probably going to happen, maybe slightly more than what the market is expecting, and that will, I think, feed into earnings.
Okay, well, before we let you go then, any cutting edge or sunrise stocks or sectors that you're spotting this Diwali, something out of the ordinary? I heard you mention, the railway sector, but anything else that you're looking at?
Amongst the large sectors, there's very little to find as sunrise. But in the smaller sectors, I think there could be stuff like renewable energy that could do well. I think smaller industrial companies. I think a new group of industrial companies will emerge. Some of the older ones or the ones that participated in the previous cycle may not actually be there. I think some of the smaller banks could find that the environment in the next 12 months actually gets better for them. So I think there could be, as I said, in the discretionary space, you could go down the cap curve there. And I think there should be some very interesting companies there which are building consumer portfolios. which could, I think, do well over the next 1 or 2 years.
All right, Ridham, thanks a lot for your time today, and once again wish you and your team a very happy Diwali. That's the call from Ridham Desai, clearly saying that earnings have lagged expectations, but going forward, things should look up. Parag,